The appraisal profession has a lot going on. You know, it seems like we always have a lot going on. There's a lot to talk about. Every time you get settled in, you feel like there's a new change coming. We had to, start adhering to ANSI, which in Kentucky we already did. We've got a new report on the horizon. Fannie Freddie now wants you to have some sort of support. Hey, how'd you get your time adjustment? You should have always had that. And those that are scratching their head and frustrated by that, I want you to think about it for a second. If a house that sold a year ago went up on the market and was offered for sale today, do you really believe that it would sell for the same price point that it sold a year ago? I mean, that just defies common sense. And I know sometimes you're in a declining market, maybe it'll sell for less. But all things being equal, generally speaking, real estate's been a pretty good investment. If you sell it a year later, if it's your house, don't you hope you're going to command more money? Even if you haven't done anything to it? Probably so. So it just stands to reason if you're appraising a similar property today and you're using that sale from a year ago, there should be some sort of an adjustment to bring it up to the current market standards. This is not new, guys. Well, we're going to talk about a bunch of things during this podcast. We're going to talk about some of the changes that we've seen, more changes on the way, and hopefully we're going to get a lot of answers to some questions you've probably been having for quite some time. I'm very excited about the guest I have. Come on back. You're not going to want to miss this one. Hi, this is Bryan Brettles. You're listening to the Appraisal Update Podcast, brought to you by the fine folks over at Appraiser eLearning. You need some education? Come check us out at AppRaiserElearning.com. We've got lots of courses on the way. The virtual course catalog is continuing to expand. We will also be at the next appraisal conference. It's actually going to be in San Antonio in April. It's called the ACE Conference. And if you want more information on that, jump over to AppRaiserElearning.com and click the Events tab, and you can find out all about it. We'd love to see you there. Please come up and say hi to us. I think my guest today is going to be there. We'll find out in a minute. And then, of course, in the summer, we have Val Expo in Las Vegas, and then we'll round out the year with the Appraisal Summit back in Las Vegas. And ACE and the Appraisal Summit, we partner up with the National Association of Appraisers to put on those conferences, and they're really great conferences. So if you've never been to a conference, do yourself a favor, check it out, sign up today, and join us at the next conference in San Antonio. You'll be glad you did. So I'm very excited. I have Mr. Lyle Radke with me today, and we're going to talk about some things. And I think because we're limited on time, Lyle, you've agreed to kind of come back and talk about a few topics. So first of all, welcome to the program. Thanks for being here.
Thank you, Bryan, for having me back.
So Lyle, just in the event there's a new viewer, maybe it's an aspiring appraiser, maybe it's a user of appraisal services, and they happen to don't know who Lyle Radke is, which would be hard to believe. Why don't you take just a second and introduce yourself to my guest?
Sure. I'm a principal in our collateral risk group here at Fannie Mae, and I am responsible for communicating to external counterparties all of our collateral policies and programs and products. I'm also very involved in the development of and maintenance of those products. This is actually a little change for me. Previously, from like 2012 2018 to 2024, I was a director, and the difference that Fannie Mae between a principal and a director is that a director has direct reports, you're managing people, whereas a principal is more of an individual contributor and a thought leader. So I was given the opportunity to move from that director role into this thought leadership role, which I really am excited about, and it's going great so far. In any case, I've either as a director or as a principal, I've been involved in pretty much every major collateral initiative that Fannie Mae has launched in the last 12 years. And so I'm very proud of our work here and how we've incorporated technology and data and analytics into improving our collateral risk management processes.
Great. Well, I really appreciate you being here today. I know you're a busy guy, and you've agreed to even come back. So I just want to set this up before we dive in today's topic and let the viewers know, we wanted to talk about so many items that impact appraisers and users today, and it would be a 2-hour conversation. And so Lyle graciously has agreed to come back, and I'm excited about that. So we're going to talk about in a future episode. We're going to talk about the adjustments that I was speaking of a moment ago. Some folks call them market condition adjustments. Some people call them time adjustments. And you guys have set what you want out, what you expect appraisers to do. And so I'm excited that you're willing to do that. We're going to bring you back for another podcast. Hopefully within the next 30 days, you guys can see that one drop. But Lyle has agreed to come back for that one. And then we'll round out kind of this series with UAD. We've got a new report coming, and it is coming. It's almost here. And as a consequence, that's gonna impact policy too, because and I know you can't really speak about policy until it actually happens, and I certainly can respect that. But if there are specifications in the UAD, the new report, that we're going to have to do, it kind of stands to reason that there will be a policy change with that. So we'll round out our 3-part podcast series, if you will. Gosh, I feel like we're on Netflix, like a little mini series, Lyle. We'll round out number 3 with UAD and potential policy changes or policy that has changed, most certainly. But today, we're going to talk about something different. And this kind of, anytime somebody's coming to the front door, I can see my dog react, kind of the hair on the back of her neck stands up, and I'm like, oh, somebody's about to knock on the door, right? And I think that's kind of happened with appraisers. We're going to talk about hybrids. And so I'm going to let you do most of the talking, Lyle, which is hard for me to do. But I really want myself included, as well as the viewers of this podcast, to hear what you have to say about hybrids, about the policy and any potential changes, and why they came on the scene. And I'm going to let you take it away. I would ask that you start very elementary and talk about what a hybrid is, because there's probably still some confusion out there as to even what it is. So, Lyle, I'm just going to kind of turn you loose and let you dive right into it.
Okay, thanks, Bryan. Yeah, a hybrid appraisal, or the concept of a hybrid appraisal, is something that's been around for a long time. Actually, it's been around for probably 20, 25 years at least. And the basic idea is that instead of asking the appraiser to go to the property and inspect the property in order to gather the description of the property, that you send someone else to do that field work, and that the appraiser focuses on the valuation. So that the actual valuation doesn't require field work. The appraiser needs to have a clear picture, an accurate picture of the property being appraised, but they can get that picture from a variety of different sources. And so the intention here is to have somebody else do the field work and have the appraiser really focus on the thought work. Now, if you go back to 2016, you'll recall Great Britain had an election in which they decided to exit the European Union. And this was a shock to financial markets and caused a precipitous drop in interest rates worldwide. And that had the benefit here in the United States of sparking a refinance boom. And within a month or two of the Brexit election, the mortgage market was going, full steam on a refinance wave, and appraisers became very busy. And we observed at Fannie Mae that there were a number of different locations in the United States where it became very difficult to get an appraisal, or where turn times for appraisals became very lengthy. So for example, we heard stories of people waiting 60 days for an appraisal, right? Now, our mission, and I'll say a little bit about Fannie Mae. Fannie Mae was chartered by the United States government. We are arguably a private company, or at least that's how we were created, but we have a mission, which is defined by our charter, which is like a law that Congress has dictated to us what our business model is supposed to be, right? And a big part of our mission is to ensure liquidity in the mortgage markets. And I think arguably waiting 60 days for an appraisal is not consistent with that definition of a liquid mortgage market. So we were looking at this problem, and it's like, how do you make sure that you can get appraisals in a timely fashion? And one thing you would potentially explore is, can we get more appraisers? But if you look at how the appraiser licensure is structured, it takes a long time to bring someone into the appraiser profession, which is fair because we want them to be professional, we want them to be excellent, and so it requires training and experience. So it's not easy to ramp up appraiser capacity in response to like a short-term market surge like we experienced in 2016. So we began experimenting with different scope of work for appraisers and different kinds of ideas for where you need an appraiser, what's the most critical function of appraiser, which we believe is a market analyst, as opposed to some of the other peripheral activities that take up appraisers' time that maybe could be done by someone else, or maybe don't need to be done at all, right, in a pinch. And so really that led to a lot of creative thinking and energy around appraisal alternatives, and hybrid appraisal is one of those. Now, what a hybrid appraisal is then is one person's inspecting the property, passing that information on to another person who is the appraiser, who is analyzing the market and determining the value. What we noticed is that in the hybrid constructs that had been in place in the marketplace for a long time, which did not have Fannie Mae sanction, by the way, they were just kind of creative efforts by other market participants, the data was very unstructured. The scope of work was sometimes not very thoughtful, not very comprehensive. And we felt like hybrid had the potential to extend appraiser capacity in times of stress, but we wanted to do it better than what it had been done before. We wanted to make sure that we were getting good risk management out of the process. So we began a pilot where we would test this, and the pilot started in 2017. We ran that pilot. The pilot is actually still running today. We're experimenting with different flavors of it. But so what we did within our pilot is we created a property data standard. So a defined set of property data elements that we would require the person going to the property to collect, and then kind of a format in which they needed to deliver this information. And along with that, we prescribed certain photo requirements. We prescribed a floor plan requirement. So this person is, collectively, because sometimes there's more than one person working on this, they will provide floor plan, comprehensive set of photos, 2 pictures of every room, plus pictures of all the defects, plus pictures of all of the things that add value, and then also something like 100, 110 different data elements that describe the various features of the house. So a really comprehensive package. Now, what we also found is that it made sense to use technology, mobile apps, to collect this data, because that ensures completeness, and it also can provide guidance to the person in the field as to what exactly is required, and it creates some efficiencies. You can do it faster and more efficiently if you're using the technology as opposed to doing something by hand. So all of these things sort of came together in our pilot. New technology for collecting or for inspecting property in a systematic way, for collecting data, photos, generating a floor plan, all through an automated process, and then resulting in a package that could be shared with a lender or with Fannie Mae or with an appraiser or with another counterparty. And this package is professionally thought out, very carefully and experimented with to make sure it's meeting our risk management objectives. So now you pass that package to an appraiser, and you say, do an appraisal using this information about the subject property, and that means you don't have to go to the house yourself. That's a hybrid appraisal.
So let me
just pause and get your reaction to that. Yeah.
Yeah. Let me just poke some questions here, okay? Because I know my viewers have many questions or opinions. Imagine that, appraisers with opinions, right? The data that you're receiving and relying on to formulate your opinion, that in and of itself, that process, I don't have a lot of heartburn with. I mean, I would think if someone said, well, would you rather do a desktop appraisal where you have nothing other than public record, or would you rather have data points and photographic evidence of what that property is? I'd rather have as much information that I can obtain in order to try to develop an opinion. Okay, so that in and of itself, I don't have heartburn. The thing that I know a lot of viewers are probably wanting to scream is, why can't I, as the appraiser, send my trainee out? Okay, and I know Fannie Mae's policy and Freddie Mac's policy on that. I can, as far as you're concerned. I get that. Or why can't I develop a team of property data collectors? I'll hire 10, Lyle, and I'll train them so that I know what I need in order to produce credible assignment results, and let me send them out. Why, if the lending community is willing to accept the hybrid with a non-appraiser going out and gathering those property characteristics, why in the world wouldn't they be receptive to allowing me to send my trainee out and do that same function?
Yeah, I mean, those are great questions, Brian, and I think at least from the Fannie Mae perspective, we would have no problem with appraiser trainees performing this function. I think you run into a couple of headwinds in terms of how you get on board. And the first problem is that this is a very technology-driven process. So you have to have technology to do this. And creating your own app is really expensive. If you're going to do, there's not a lot of property data collection as a standalone exercise happening. I think in our pilot program, which again has been running for 7 years, we've done something like 300,000 of these. Which may sound like a lot, but if you're trying to build your own app and you're expecting to do 10 or 20 of these a month, you're going to be, many years into this before you ever pay for your upfront investment. So I think that is a barrier to entry, just the cost of creating apps. Now, you could license somebody else's app. There are apps out there that you could license. So then that would be fine. We'd have no objection to Bryan Reynolds licensing somebody else's property data collection app And building a team of property data collectors and going out into the mortgage market and soliciting work as property data collectors, be perfectly fine with that, right? Second issue is that not all property data collection results in an appraisal. So we have another product which we call a value acceptance plus property data, where the only thing we're doing is getting the property data, where we already have a comfort level with the value, so to speak. And so we're not requiring an appraisal. And again, that's a small bucket, but it's a significant fraction of all the property data collection that's happening. And so you could still do that. Like, it doesn't change the basic paradigms. You could do that, but it's not leading to an appraisal. You're not going to hand it off. You're just going to deliver it, right?
So I know we're focusing on hybrids in this conversation. Two things with that. If you're having a property data collector go out and gather those characteristics and you're not even doing an appraisal, I assume that's going to be a waiver.
Yes.
If you've used something for the valuation other than a traditional appraisal, and I just want to make my position very clear, and Jeff Bradford brought this up to me years and years ago, and I'm in full agreement. I think appraisers should be involved in all valuations. So I just want to get that on the record. Okay, that's just me. Even evaluations, I think appraisers are the best to do those. But you're using something for that. If you're comfortable with the value, Lyle, why is there a need for that property data collector on those particular loans? I'm just curious.
Yeah, when we offer an appraisal waiver, and actually we don't even use that term appraisal waiver because it's not technically correct. Okay. Legally, Fannie Mae is not required to get appraisals. So we don't have to waive something that we're not required to get.
Makes sense.
We choose to get appraisals because we think they're good risk management, right? But in some cases, we don't choose to get appraisals. And what we call that, our brand name for it is value acceptance, right? Mm-hmm. So I would take issue with calling it an appraisal waiver because we're not waiving something. We never required it in the first place, right?
That makes sense. Thank you for that, because I think that'll give clarity to, certainly just gave clarity to me, and I think that'll give clarity to my audience as well. So thank you for that.
But it is commonly referred to that, so I'm comfortable discussing it on those terms. In any case, our value acceptance or our appraisal waiver policy requires a prior appraisal observation. So you can really think of it as an appraisal reuse program. If we have an appraisal on that property within the last less than 6 years, then we'll take a look at that prior appraisal and we'll look at current market conditions and we'll say, does this make sense, right? Does this new loan application make sense in context of that prior appraisal and what we know that's happened since then? So the cases where we might want a property data collection are when, let's say, that prior appraisal says the property is subject to repairs, but we never got any confirmation that the repairs were made. Or maybe after that prior appraisal, there was a hurricane or a wildfire disaster, and we aren't sure if that property is still standing, right? If it's been damaged by the disaster. Or another scenario would be if we didn't have a prior appraisal. We have a lot of market analytics, and we might be able to say, based on everything we know, we think this value is great. And an example of this might be, let's say, a low LTV loan. So let's say the proposed loan to value ratio is 30%, meaning the property's worth $300,000, but they only want to borrow $100,000. It's like if that value is anywhere in the ballpark, you're good to go. Like, you could be way off. Let's say it's only worth $200,000. You're way off. That's still a good loan. You're only borrowing $100,000 against a $200,000 house. So our economists have looked through the capabilities of our data and our technology, and they can pinpoint the loan applications where we're highly confident that this value is acceptable within kind of an LTV framework. But we haven't seen that property recently. Maybe we've never had a prior appraisal on it. And so we want to just make sure we know the property characteristics and we know that it's eligible for our lending box. So that's why we would want a property data collection, even in a situation where we're already pretty comfortable with the value, right? You're comfortable with the value based on certain assumptions, and you want to validate those assumptions by getting the property data.
What is your concern or your thoughts about accountability for the property data collector? I mean, I've heard a lot of folks say they should be licensed, or they should, have more training than just a short little training piece. What's your thoughts, or what's Fannie Mae's thoughts on, the PDC and the accountability thereof?
Well, we first of all, Fannie Mae is not allowed to lobby for any particular public policy. And so officially, we do not have any position on whether or not property data collectors should or shouldn't be licensed. Honestly, is my own personal opinion. I don't see any harm in it. Like, okay, go ahead, license if you want. That's responsible. That's how other professions have some accountability to the state, and so I wouldn't see that as being a problem. In terms of training, I mean, more training is good, but the training that property data collectors need is very specific, right? And it's different than what, let's say, an appraiser or a real estate agent would need. So a real estate agent needs training on contract negotiation and training on customer service and training on a lot of things that real estate agents do that, that are proprietary or specific to their role. Same thing with appraisers. Appraisers need to understand market analysis and all the techniques for deriving value, right? Very specific to that. Property data collectors don't need to know any of that stuff. Like, this is a mechanical task. You go into the house with your app, you answer the questions, you take the pictures, you're done. For most of these, the floor plan is even automatically generated. Like the app has a built-in feature that uses either photos or LiDAR to automatically measure the house and produce a floor plan. So the person's not even, literally measuring the house. So it's they do need knowledge, right? You need to know the difference between a bathroom and a kitchen, because you're going to label everything, and you need to be able to identify defects so that you can take pictures of the defect. But you don't have to pass judgment on anything. You're just taking pictures and describing, right? So it's a very fact-based exercise and a very technology-driven exercise. So I'm all in favor of more training for property data collectors, specifically around property defects. I think that's maybe the steepest learning curve. But a lot of this is very, very mechanical and very tech-driven, and so they don't need to know a bunch of stuff that appraisers need to know.
We're talking about value acceptance earlier, and you said you may not get an appraisal, but you get a PDC, is what I'm referring to it as. What happens if that property comes back substandard, or it comes back with some deficiencies? Will that trigger now the need for an appraisal, or how do you guys handle that?
So when we launched that policy for value acceptance plus property data, we did define a kick-out to a hybrid appraisal, but it's not based on property defects. It's really based on a change in the loan terms. So there's the VA plus PD has LTV caps, and what you might find is that the borrower at some point during the loan application process comes in and says, hey, I actually want to borrow more money. I was going to put 10% down, but now I've decided to buy a new car to put in that new garage, and so I want to only put 3% down, right? Well, now they're not eligible for the value acceptance plus property data because that LTV is too constrained, right?
Change that, yeah.
And so then in that case, we would say, you've already gotten that property data. it doesn't make sense to send someone else back out to the house to do the same thing. So let's jump to a hybrid appraisal and just deliver that property data to the appraiser. So that was our limited use case for a kick out to a hybrid appraisal for VA plus PD.
Well, I want to ask you a couple of questions, and you may not know the answer. And it's okay if you don't know the answer. I don't want you to guess and be wrong. Do you know what percentage of appraisals or loans deal with this value acceptance where there's no appraisal whatsoever, okay, versus what percentage are we looking at for hybrids and what percentage are we looking at for more of a traditional appraisal? Do you have any idea what those percentages might be?
Yeah, so first it's important to know that the offer rates are dependent upon the type of loan and the loan parameters. So for example, we're much more likely to offer a value acceptance on a rate term refinance, because with a rate term refinance, there's no new risk exposure, like you're just getting a new interest rate for your old loan. And I mean, that's a bit of an oversimplification, but it also is when you have very low interest rates and you have these refinance booms, that's exactly the time when you kind of want to take the stress off of the appraiser population. So we've designed it so that, when loan volume is exceptionally high, the waiver offer rate is going to be higher. And when loan volume is exceptionally low, the waiver offer rate is going to be lower, right? So it's a buffer for appraiser capacity. So we're not targeting any specific percentages. Like we're just saying, if the loan fits within our eligibility box, we'll give you the offer. And if it doesn't, we won't. And then, whether or not loans fit within the eligibility box is kind of a function of the market as to what kind of loans lenders are generating. So, but I can't answer your question for right now, right? Right now, the value acceptance offer rate is somewhere around 10 to 15% of loans. And the value acceptance plus property data offer rate as a standalone is a little less than that. So maybe 5 to 10%, something like that. So collectively, they might add up to roughly 10% offer rate, or I'm sorry, 20% offer rate. But we find that in practice, lenders don't always accept. So there are a lot of situations. A typical case would be the purchase contract may have an appraisal contingency, and so both parties are constrained to get an appraisal, right? So then if we offer them a waiver, they'll decline that and get the appraisal instead. So the execution rate for the most recent that I have information on, Fannie Mae's the percentage of both combined was about roughly 13%. It was a little less than 15%. So that's kind of like 1 in 7, 1 in 8 loans.
So if I round it up to 15%, you're telling me that 85% are still getting a traditional appraisal. That be whether it be a drive-by or the appraiser's going into the property. Is that what I'm hearing?
Yeah, I didn't say it, but the desktop appraisal rate is less than a percentage of all transactions. And the hybrid appraisal rate prior to this announcement was really trivial. It was also much less than 1% of all transactions. So yeah, those barely add to it. The value acceptance plus the hybrid plus the desktop plus the value acceptance plus property data, all of them combined were maybe 15% in the current market.
Okay.
Now, if you went back to 2021, when refinance boom was in full swing, that value acceptance population was closer to 40%. But that 60% that were getting appraisals was still like 4 times more loans than the ones getting appraisals today, just because the pipeline was so much larger.
Yeah. So if there's an appraiser watching right now and they've been very, very resistant to do a hybrid, right? I'm not going to do anything unless I go in and smell it, touch it. And I used to be one of those appraisers. I wouldn't even do a drive-by because I had the philosophy, by God, if Bryan Reynolds signed his thing, he got to go in, look at it, see it, smell it, touch it, right? And I finally came off of that. I'll do a drive-by now. I mean, I've done property where it's burned to the ground. There is no improvement to the land. It doesn't exist. I may be doing some fire damage work coming up. I talked to an attorney just yesterday, and the houses are gone. The commercial properties are gone. So we use other means of trying to figure out what was there before the day before the fire burned it to the ground, right? So what would you say to an appraiser? I mean, you've been an appraiser. I mean, what would you say to an appraiser who's now thinking, okay, well, I've resisted this and maybe it's an opportunity, but I'm just not so sure. They're thinking about dipping their toe in the water. I mean, what would you say to an appraiser?
Well, the first thing I would say is that USPAP is very accommodative of this. This is all about scope of work definition, right? And you've pointed out some examples. I could come up with some more. Like if you're doing an estate a sale and it's a retrospective appraisal back to the date of death, it's like you can't go back in time. You're never going to really know what that property was like as of date of death, right? If you're doing proposed construction, it's like it's not built yet. You can't look at it yourself. You can look at the plans and specs, but it's not actually built, right? There are foreclosure situations where the lender wants to know what the value is, but there's an angry homeowner inside the property who's not going to let you in, right? Are you going to decline that, or are you going to? The lender needs an answer. If appraisers won't sell them the best answer, then they're going to go get an answer from somebody else because their business requires an answer, right? And I think the scope of work rule allows appraisers to figure this out and to really negotiate this, and also to communicate this clearly. So through your extraordinary assumptions, through your limiting conditions, through your disclosures, you tell your reader what you have done. And if the reader is your client and they ask you to do it, then there's a lot of protection for the appraiser in that. Now you still can't do things that are dishonest or unethical. You have to be clear about what you've done and why you did it. But another thing that we've done, and I'm going to read this to you. I've got for a hybrid appraisal, we have a different form. It's not quite the same as the standard URAR, and we've added limiting conditions to help limit appraisers' liability in terms of consuming the property data, right? So I'm just going to read you limiting condition number 4. This is from the hybrid appraisal. It says, unless noted otherwise, the appraiser has relied on interior and exterior subject property data obtained through a property data report. Such data includes, but is not limited to, a floor plan, photographs, and property characteristics. After examination of the data and data sources, the appraiser has used only the data he or she considers reliable. Okay, so that's an important point. Appraiser doesn't have to use information that's not reliable. They can use a different source. How would you know whether or not it's reliable? Well, you've got a different source that you think is better, right? Otherwise, you wouldn't know if it's reliable or not. But let's talk about that. What if you don't know? The appraiser assumes there are no material omissions and makes no guarantees, express or implied, regarding the accuracy of this data. I mean, that's a get out of jail free card for the appraiser. Like, I assume it's good. I'm not guaranteeing that it's good. Somebody else did that, right? Also, one last extraordinary assumption here that's built into the form. The appraiser assumes that the property characteristics have not changed since the date of the property data report. So, I mean, to me, that reads very clear and very specific. The appraiser's saying, I got this property data. I've relied on it. If there's something in there that I know is wrong, I didn't rely on that. If there's something in there that I'm not 100% sure, guess what? I'm not guaranteeing it. And now you've been forewarned, right? And as my client who asked me to do this, you know that that's your risk. You're at risk for the unknown.
Lyle, thank you so much for being here. I've kept you way too long. Is there anything that you want to say in closing on the topic of hybrid before I let you go?
Well, I think I would tell our appraisers that while the eligibility bucket is very large for hybrid appraisals, we don't really expect that there's going to be a high adoption rate. And I think the reason why we think that is number one, what's happened with desktop appraisals. Only about 1% of the eligible loans that are eligible for desktop appraisals actually get a desktop appraisal. And then number two is, if you think about what you're doing with a hybrid appraisal, you're taking a simple one-step process, the traditional appraisal, where lender goes to appraiser and says, I need an appraisal, need it on the UR/AR. And the appraiser knows shorthand exactly what that means, and they take it from there, and a week or two later, they deliver the full package to the lender, and the lender's like, yay, thank you, done, right? Very simple for the lender. Now you're taking that and you're breaking that in two, and you're adding complexity. Now the lender has to manage this piece and manage that piece, and they're paying someone to manage this piece, and they're paying someone else to manage that piece, and everything gets complicated, right? Lenders hate complexity, so they're not going to do this unless they have another strong motivation to do it. And so we think it's a niche tool where, if we get into a refinance boom where turn times are extra long, or if you happen to be in, like a small market, a rural market where it's hard to find an appraiser, or hard to get on their calendar, or they have to drive a long ways, then maybe there's a potential for lenders to take this up. But I see this as kind of a niche tool. So even though we've made it broadly available, I'll be really surprised if it makes a big impact on appraisers' business at this point in time.
These lenders will take the PDCs. When can we quit requiring appraisers to drive by and get comp photos? Is that on the horizon anytime soon? I mean, I know there's different opinions, and I know there's a reason to drive by. You're not just taking a picture, but I was out the other day and it was dangerous. I mean, I'm stopping on a dangerous highway to get a flipping picture that you can't see anyway, because all you see is a bunch of trees. And so anyway, I would like to see some leniency there. That's another.
We are very interested in that.
Okay.
That's something we're working on.
Oh, great. Well, that's refreshing to hear. Mr. Lyle Radke, thank you so much for spending some time with us today, and thank you for agreeing to come back with some other in-depth conversations right on the horizon. Hey, if somebody wants to reach out to you or a member of your team, what's the best way to reach out to you?
If you go to the Fannie Mae website, there's a contact us link, or in particular, if you Google Fannie Mae appraiser, it'll take you to our appraiser page, and there's a contact us link, and that's the best way to contact us.
Great. We're going to see you at an upcoming conference?
Yeah, I'll be at ACS.
Great. And ladies and gentlemen, that's the nice thing about Lyle and his team. They're very approachable. I mean, don't run up and grab him and yell at him, but I've always admired that about you. You come into the lion's den sometimes, but you're willing to talk to a boots on the ground appraiser if they want to grab your ear. Yes.
Absolutely, yeah, and I'll be at other conferences and in-person events this year, and happy to talk with anybody. If you can catch me, I'm happy to talk.
It's a wonderful thing. When I started out in this profession, there weren't conferences, or if there were, they weren't well advertised, and you never had an opportunity to sit down and talk to Fannie Mae via a podcast or in person. And so I love that we have that ability, number one, and number two, that you're willing to do that. Mr. Lyle Radke, thanks for being here today.
Thank you, Bryan.
Ladies and gentlemen, you've been listening to the Appraisal Update Podcast. If you haven't watched us, jump over to the YouTube channel. Go to YouTube, search Appraiser eLearning, and you'll see the podcast being recorded. You can actually see us. And while you're there, go ahead and hit the subscribe button, because that will keep you in the know. Sometimes we have special podcasts or special announcements, and you may not even be aware of those unless you're a subscriber to our YouTube channel. So we certainly encourage you to do that. I'm very thankful for Lyle being here today, and he's agreed to come back, and we're going to talk about time or market condition adjustments, which I'm really excited about, as well as the UAD, the new report coming, and it is coming. So you better wrap your arms around that. Whether you're ready or not, you better get ready. Ladies and gentlemen, you've been listening to the Appraisal Update Podcast for Lyle Radke. I'm your host, Bryan Reynolds. Until next time, happy appraising.
The Appraisal Update Podcast is brought to you by Appraiser eLearning.